All right. Welcome you guys to Hex's class. This is going to be on the day of December 23rd, 2020. The topic is going to be liquidity targeting and top-down analysis. We're also going to be doing a couple of Q&As afterward. So firstly, I believe that a lot of you guys had a bunch of questions regarding liquidity targeting. So liquidity targeting is something that is extremely important for all of us to understand. However, it's also something that should come similar to the earlier classes that we've been speaking on liquidity. I want you guys to understand liquidity targeting. Also, thank you, Tyler. We want you guys to understand how liquidity targeting affects the actual study of liquidity. So, who here is familiar completely with liquidity? Like, who here is familiar with what liquidity is? And I believe Zay had a class on this last night, so I believe it should be something that should be coming fairly simply to most people. So most people are mostly clear on it. Remember, guys, if you guys do not understand what liquidity is, please make sure you guys speak on it. I'd rather you guys understand it now and like make me reteach it than you just like not understanding what's going on. I just need more practice noticing it. Okay, let's go over a couple live examples of what liquidity is. So as Zay was saying last night, right? Let's actually go back and let's replay this position here. Let's replay this position here really quickly. So when we focus on this little little circle right here, right? We're gonna think about liquidity as extremes, right? Market extremes. So this one should actually be done here a little bit. So if we think about liquidity as market extremes, we're going to mark them usually as equal highs. We can mark them as, for example, we can mark them as right here, we see these equal highs. So above this, what's going to be there? That obviously there's going to be liquidity, right? Below here, we also see a market extreme, which means that most likely there's going to be liquidity. There are actually two places where we could find liquidity. And the second place is actually right here. Can anybody tell me why liquidity would also be found there? Can anybody tell me why? Equal lows, break of structure, equal lows. Yeah, so all of you guys are right. In this case, it would be this this level right here would be another piece of liquidity. What another thing that you could signify as liquidity is right here, though this would be more of a market magnet, right? A price magnet. You have this inefficiency, right? This inefficiency right here would be considered a magnet, not a piece of liquidity. Well, you could kind of signify it as both. I just like making that distinction because of the fact that they do serve different purposes, right? So in this case, we know that this equal low here is going to be liquidity because it retested this rally-based rally, right? This piece of structure here, and it actually filled this like this right here created those lows. So if we kind of like replay it back to around this position, what's the previous low? So we obviously see a liquidity pool here, but we also see a liquidity pool below it. Right? We see a liquidity pool below it because right here we have all of this liquidity that's just waiting to be taken because of the bank's inefficiency, right? And remember that bank inefficiencies, they're really just how the algorithm prices the market. So it's not, like say for example, that there are like a certain amount of bulls or bears. It's really just that like that does matter, but it's also how the market prices, like how the algorithm prices, and how it intakes prices. So if there are those inefficiencies, obviously banks do want to correct those So they do return to them. So right in this little return, it didn't go all the way down as far as we would have wanted, which is perfectly fine. But at the same time, we want to realize that this right here is a magnet for price, and below it, and below this equal low would be a liquidity pool. Does everybody understand that? So above these equal highs is going to be your liquidity pool. Below this most recent low, and in between these lows, right? In between these lows, there's a liquidity pool, right? In between these lows is going to be a liquidity pool. So now a lot of people have been asking about breakers and about, different market structures. So where is the point? So in this case, we see that this move here from point A to point B created new lows. It took liquidity, right? It created new local lows, right? It created new local lows. It rated this liquidity pool, this liquidity pool. So we took all this sell side liquidity. Now, the most important thing about this piece of liquidity is the fact that we've also now realized that what was the position that actually broke the equal highs. So like, for example, right here, we could have had these equal highs right here, right? We could have also had these equal highs right here. What broke both of them? Where did that move originate? Where did that move originate? Right from this green line, right? So this box right here is going to be where this move originated from. So that is going to be what you can distinguish as either a breaker block or a mitigation block, whichever one of the two. In this case, it didn't completely break equal highs, which is why I would really call it a remitigation block. But at the same time, you could also say that it is a breaker because it broke these immediate highs, which would also be a valid answer. It's really up to you. You could call it just a breaker block as a gimmick. And then from there, you'd realize that this is the origin, right? So a breaker block is the origin of where the market has created a run on stops or a run on liquidity. Because a lot of people will say, like, let's think about this from a trend line perspective. Let's throw the smart money out the window. Let's think about it this way. We're trading like retail. We're going to see this trend line, right? We're going to see this trend line. Now let's go a little bit further back. Let's not even like, let's do this, right? So we're seeing this. What would we do as trend line traders, as retail traders? We would say, okay, well, there's a support right here. There's going to be, a resistance that got broken right here. So, oh, we're bullish, right? So it retests and we get, like a 50 pip stop to like a 70 pip TP. We get a TP hit, right? We're so good. Now, from here, let's think about it from a retail perspective. This is something that ICT teaches, and he's actually really good at it. It's called like phantoms, right? So these phantoms are essentially like they're fakes, right? So they're things that retail sees that we as smart money traders do not see. So do not take anything that I'm showing here seriously, because this is not how you trade, right? But this is what people like to say, what they like to show. So let's say, for example, we see this trend line here, right? When we see this trend line, and then we see price do that, what do we expect? Actually, so let me actually rewind it to like back here. What do we think is going to happen at this point? If we're trading, so if we're just trading trend lines, right? We're going to say like, oh, it broke the trend line to come back down to this previous support, right? So we're going to take a buy with a 50 pip stop, and we're going to clear that, right? And we're going to say, oh yeah, we're super good, like plug in, right? Now, some people may also say, hey, at this point here, it's breaking out. I'm going to retest, right? It's going to retest and it's going to go short. So I'm going to do that. I'm going to, I'm going to put my stop loss here. I'm going to put my, 70 pip stop. And then I'm going to do like my target all the way down here because I'm such a good trader, right? Now what's going to happen? Well, we've already seen what happens. Our limit gets triggered and immediately our stop loss goes out and gets demolished. So we see our stop loss got hit. So that's already one loss for retail. Now it broke out through the other side. What do you think retail is going to be thinking now? Break and retest again. We're on some different strategies here, right? We're gonna take this break and retest. So now we're gonna retest all the way back here and previous structure, right? Quote unquote previous structure. And we're gonna say, okay, well, awesome. We're gonna retest here. Or well, I'm not a break and retest trader, so I have no idea where you'd actually enter. But let's say you entered right at the trend line. You did an 80 pip stop. But then you're targeting these new highs because you're institutional, right? And then what's going to happen? Well, we already know what's going to happen. Your stop loss gets immediately demolished. And at this point, these retail traders just lost 2 trades. If you got lucky with this support and resistance trade, you maybe made, a couple hundred pips. But that's it, you got lucky, right? So at this point, what are you thinking as ex retail traders? What are you guys thinking? Unlucky. Okay, so some people are thinking that unlucky. What about everybody else? Like, what are you guys thinking? Like, as ex retail traders, what excuses would you put here, or what thoughts would be going through your head? Not excuses, but what thoughts would be going through your head? Fake out. Okay, fake out. That's a valid response. Okay, fake out. What else? I need all of you guys to answer. Don't be shy, guys. Seriously, don't be shy. The only way you guys are going to get better at this is if you guys put yourself out there. Because as an educator, it's my job to help you guys, and I'd be glad to help you guys. But I need you guys to also speak to me because I can't read your mind, right? Market manipulators, right? Market manipulation. A lot of people are saying like, "Oh, news came out," right? That's the biggest excuse we also hear. News came out. Well, if news really came out, then shouldn't we be able to predict where the market is going to go due to those news? Well, the truth is, and if you're new here, the truth is that news are simply an excuse for market makers to move price wherever they'd like. So if they're gonna, if price is already bullish and there's already a bullish order flow, watch how news affects it. It's gonna affect like news is gonna be affected very lightly, and it's literally going to push price where the banks intended it to go in the first place. So don't trick yourself into thinking that news is simply like news is the reason for everything. News can have a factor, but the only thing that news is useful for is seeing what time of the day or what positions really the market will take in that day. So for example, let's say we go, and actually I'm going to take a second from this, and I'm going to go to Forex Factory, right, really quickly. It's where a lot of people get their news. So today is December 23rd, right? Let's go to a day where there was a lot of red folder news. I don't know when there was a lot of red folder news, but okay. So let's say we're going to December 17th, where there was a lot of red folder news. If we would go back and backtest what have every single one of these red folder news, I guarantee you there is a reason why the market turned. Whether it be an order block, whether it be a lower time frame inefficiency, whether it be a lower time frame position, whether it be a deep retracement, whether it be a return to premium or a breaker block, a mitigation block, a remitigation block, there's always going to be something that impulses these, because banks are going to see these and they're going to say, okay, well at 7 a.m. I already know the result of this. So even though we personally as traders are waiting, like we're waiting for all of these news, quote unquote, to come out, banks already know the answer to these. They are, I think by law, they have to know the results of them, I think, a week prior. So like at the beginning of the week, they have to know the decisions for these things. So for the most part, they already know what's going to happen. So if they already know what's going to happen, they're not going to care that you know what's going to happen. All that they're going to do is they're going to move price extremely fast from point A to point B more than usual, because then what do you think they're going to tell the CFTC or different other regulating agencies when they come over here and they say, well, why did you manipulate the market like this? Oh, we didn't manipulate the market like this. There was simply news, right? There was news out that day. So that's why the market moved that fast. Well, what can the CFTC do at that point? They can't do anything because there was news going out at that point. So all they do is use news as excuses to move price extremely fast. That's exactly what happens every single time that there is a big news release, like red folder, stuff like that, red folder, orange folder. A lot of times there's a lot of injected volatility, and this is actually something that I need you guys to write down in your notes. Injected volatility, and that is when the markets, that is when the big banks, the manipulators of the market, enter the market in such a way that they actually end up they actually end up injecting their own money, which causes a reaction, like a knee jerk reaction from the market. So as soon as they enter, the market immediately moves in the direction. That is what that knee jerk reaction is talking about, right? So when all of these news come out and banks suddenly move the GBP pairs bullish for 300 pips, well, they now have a reason for it. And the reason for it is, well, news, right? News is going to be their reason for that. What's the main time frame that banks plan their moves? Do different banks create conflicting moves, or are they all colluding? Usually they're all colluding. They don't, like contact each other and are like, oh, well, this. No. Usually the algorithm just prices in where price is going to go, right? So banks aren't at their computer every single day. What they do is they have people manage their algorithm. So I'm not gonna tell you that I've been inside of a hedge fund, but from the insider information that I know, I do know that they have algorithms that trade for them, and those algorithms are the ones that kind of that the ones that move the market. Though they leave those footprints, which is what we call as technical smart money. Those are the footprints that we follow. And as for the main time frame for the banks to plan their moves, usually, remember, I said this in the boot camp, usually it's from the weekly to the daily to the 4 hour. Very rarely will they be on the 1 hour. Though remember that algorithms usually can't handle big data very well. So what are they also going to be using? They're going to be using lower time frame data. So let's also think about that in the way that price is fractal, right? Even the big teachers like ICT have said that price is fractal. What does price is fractal mean? Well, it means simply that price is going to show its hand on the lower time frame before it shows its hand on the larger time frame, right? So whatever happens on the 1 minute is going to affect the 3 minute. The 3 minute is going to affect the 5 minute. The 5 minute is going to affect the 10 minute, the 10 minute, the 20 minute, the 30 minute, all the way up to the weekly, right? That's what price being fractal means. So if we go back here, right? If we go back to was it EU or GU? Yeah, if we go back to GU, right, and we're looking at this position, let's say that there is some sort of news that caused this spike. And let's say there's some sort of news that caused this spike. And all of a sudden, well, wow, we're at a position where people are getting their money robbed, and this supposed run on stops is something that people aren't expecting. However, if we let price continue on and let it flow, we would realize that this position all was inspired from a higher time frame order block, right? And it met the equal high. It never broke the equal high. So it's still a valid retracement, right? And we're also on the 12 hours. So if we would zoom in, we'd probably have a much better entry on lower time frames than the one we have on the 12-hour time frame. That's why it's important to look at both overall price action or general price action. That's where top-down analysis actually comes in. So if you're doing your top-down analysis and you're seeing this position here Well, a lot of times when we teach you how to use order blocks, you want to look at the 50%. However, in this case, since you're on such a high time frame and you're literally looking at just general price action, you might want to refine your entry and look at this entry from a lower time frame perspective. So in this case, right here, right, you'd be looking for, say, an order block or an inefficiency or maybe even distribution here, right? Lower time frame distribution. So then in that point, you can't argue with this move here because all that it did was clear this liquidity. Because if we delete all of this, right, if we delete all this nonsense that we have on our chart here, we are left with something quite interesting. And that's that this here, right, these here actually did have liquidity pools. So right here, right here, it actually did have a liquidity pool. So it had one liquidity pool right here. And it had another right here, right? So the only purpose of this move was to collect all this liquidity before they shut down. Of course, they were amassing liquidity over this distribution schematic, but at the same time, we all need to realize that they need to collect liquidity just before they make that big move. So what do you think happened? Well, what they did is they collected liquidity one, liquidity two, and then that is why they popped this entry here, right, to move price higher. Now, when they moved price higher, what do you think? What type of orders did they need to accumulate here at this point in the market, at this point right here? What do you think they needed to amass? What type of orders? Bullish or bearish orders? Buy or sell orders? So I see bull, I see bear, I see buys to sells, buys, buy to that price up, to make move high, buys and sells, major buys but also sells. Right. So I like all of your answers. All of your answers are very, very good. And they all make sense. But now let me give you guys the actual answer. So they have to stack both, right? They have to stack both. But for the most part, if they're coming back here, they're remitigating these orders. So up here, right up here, they did have bullish orders. They had a lot of bullish orders which were in drawdown, right? So the purpose of this remitigation of this position was to actually take out and delete all of these orders so that they could go about their merry way and keep going even lower, right, without any difficulty. So what do you think they needed to do? Well, at this point, they took all of the sell side liquidity down here, right? They took all of the sell side liquidity down here. So what do you think they needed to do next? Well, obviously, what they needed to do next is collect the buy side liquidity. Now, where was all the buy side liquidity located? Well, right here and right here, right? So where was the previous major orders of the banks? And realize that orders of the banks are gonna be all around the chart. But we're looking at the major positions, where the markets most likely have bank orders, which are usually going to be at the extremes, because banks usually don't like to enter in the middle of a move, right? They have to cause that move. So in this case, we know that the last major position was right here, right where I'm circling. Um, how to ID major ones? Well, major ones usually are the largest impulses or the most noticeable impulses. So this impulse right here, we know that bank sponsored this. This impulse right here, we know that bank sponsored this. We know that bank sponsored this because it took liquidity. Usually, and I'll give you a little hint here, Alpine. If a move takes liquidity, 9 out of 10 times it's institutionally sponsored. Okay? If a move takes liquidity or moves toward liquidity, more than 90% of the time, it is going to be an institutionally sponsored move. Now, when we think about that, we know that they remitigated this position to get rid of these. However, if they wanted to get rid of these orders, they had to get orders somewhere else in the market. They didn't want to put orders up here, right? They don't, because that'd be very inefficient. Then they have to come up extremely close, which, considering this drop, is going to be very, very pricey for them. So where's the next best place for them to actually put buy orders? Why didn't we expect the major banks to come back up to the first major move before coming back down? So you're talking about this? Yeah. So you see this inefficiency right here? More than likely, this was, so we're also in the 12-hour chart, which is a pretty funky chart. But if we were to look at this, more than likely, this position here being an inefficiency, it filled as much inefficiency as it possibly could and then continued its mitigation. So it would be kind of expensive for it to first off take this liquidity and then continue on going higher and take this liquidity. It would just make a lot more sense and a lot cheaper sense, right, for banks to just halfway mitigate, close out certain losses, and then from there continue amassing liquidity right here. And also, you could also take this from a reactionary perspective. Say this move already happened and you just happened to miss this order block move, right? Let's say you happen to miss this order block move. That's fine. That's exactly why I'm setting up the next position for you. Because if we look at this, right? If we look at this and we see what's the next position that banks are going to amass buy positions at? Well, they moved this price, right, to take out all this liquidity. So they took liquidity one, liquidity two, they came back and remitigated. So we know that 9 out of 10 times, those moves are institutionally sponsored, which should really be 10 out of 10 times, but I can't say that because that's illegal, right? So we just push up and take all this liquidity. So we know this is institutionally sponsored, which means that we know we have big buy positions here. We could also enter big sell positions there. That's fine. But when they push this move up, oh, wow, miraculously, all of a sudden they closed out all of their buys and break even. And now they are, they're in blues because most of their sell positions are from here, 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 and here, right? And where they're going to be amassing a lot of their bull positions, they're going to be holding it here, right? So we're going to have to take this block into consideration in the future. So now we see this recovery from GU. How to determine the money volume wise at the inefficiency? I'm assuming the higher they are, the more they will become the target. I don't think I quite understand your question, bro. Could you maybe rewrite that and I can answer it a little bit better? I'm not sure how you mean. So right now we're seeing how price creates this double top, right? This liquidity. We see that it taps into this. So this is actually a very noteworthy thing. So you see how it taps into this liquidity pool? It taps into this liquidity pool, so it already took this sell side liquidity. What's next? What do you guys think is next? Upside liquidity, perfect. I'll come back to your question in just one moment, Alpin. Exactly. So they already took the sell side liquidity. Now, for all of my beginners, is everybody familiar with this concept? Does everybody understand everything I'm saying until up to this moment? I would rather you stop me now and tell me that you don't understand. Okay, question. All right, Fritz, go ahead. Also, Miss Mel, the sell side liquidity is right here. So as we discussed earlier, this creating these equal lows and this being the earlier local low makes this a liquidity pool because we have this magnet for price, right, where liquidity needs to stabilize, needs to reach equilibrium. And then also we see this position here where this low that was created became this liquidity pool. So we took this sell side liquidity. Now we would look to seek this buy side liquidity. So we would look to take this out. Could you have entered on the inefficiency of the candle at the 50%? You're saying right here? A lot of times with inefficiencies, bro. Okay, go ahead. Down. I'm not sure where you mean. You're saying here or where the magnet is? Oh, right here. Well, it didn't reach halfway. So the halfway point would be right around here. It barely missed the halfway. I also wouldn't do that if I were you, not on this big of a gap because that's a really big gap. It's a 12 hour. But I mean, you can if you want to risk it. Just me personally, I would have to have some type of confluence behind it, meaning confluence just means added proof. So whenever you're trading, right, you have the burden of proof, and the burden of proof in legal writing is you have to convince me, or you have to convince yourself in this case that you are correct. You have to present all of the evidence to make your to state your case, right? So in this case, you have one piece of evidence, which is this solid piece of liquidity, right? This solid piece of price magnetism, which more than likely is going to push price lower, right? And is going to attract price to at least 50%. Now, in this case, it missed the 50% barely. However, we do know that in our burden of proof, we could definitely say, yes, there was a magnet to price here. However, what else is there? That's all the confluence you have. Almost quite, that's almost all the confluence that you have. So in this case, I would not suggest you to use it because of the fact that, like, I would not suggest you to get in on 50% inefficiencies whenever you see them, just because there is no confluence behind them. Now, if there was a breaker block or if there was a mitigation block behind it, then you could state a different case because then your burden of proof grows because then you don't only present one piece of evidence, you present two pieces of evidence, right? And then from there, you build your case a lot longer for taking this trade. Does that make sense? Does that make sense, Fritz? Okay, awesome. Um, how do we know that what side is going to take first? Would you say that where price is closest to? That's a good question, and the answer is no. You want to be reactive to this, right? So it's really where price is going to, it's really where price ends up flowing toward. So in this case, right, we see this double top be created, and when it starts making its way down, we realized that it created a liquidity pool, but it did not create this low side liquidity pool, right? It didn't reach it. It didn't break above it, but now it's heading beneath it, right? There is no reaction. There's no order blocks here. So there's no reaction. The only order block that was right here was already mitigated. So you could easily say, well, in this case, there's only one place left to go, right? And we see this sell side liquidity get taken. We see this sell side liquidity get taken, and now we can expect price to go all the way above. Usually, and this is something for your notes, usually what happens with liquidity taking is usually it does something like this. Usually it does something like, let me, so let's say price is like that, right? Let's say there is a thing of liquidity like this. If buy side liquidity gets taken out first, it will take sell side liquidity next, and then it will make its way towards the buy side liquidity again, right? That's essentially what it would do. Now, if we have the same scenario, but instead it breaks below first and then it goes above again, usually it ends up making its way back down. So it kind of works like a ping pong, right? So if we see this liquidity, if it takes sell side liquidity, we know that next it's going to take buy side liquidity. And then from there, we want to wait for our cue to get into those sells because usually it's going to come back and it's going to go the original direction that it wanted to go. So the direction that it goes first is usually where price is going to go toward in the long term after taking both sides of liquidity because it wants to stop out as many people as it can. So it's going to trigger as many sell stops, as many buy stops, as many stop losses as it possibly can. So back on topic, right? We took this sell side liquidity, and I think Miss Mel had a question. So it's sell side liquidity because they had sold at a higher price and buy it back at a lower level. Uh, I think you're asking about bank logic. In this case, we're just talking about liquidity. Liquidity is just where money lies, right? And why are we saying that money is there? It's very simple because a lot of retail traders will have their stop losses back here. A lot of retail traders will try to, try to milk the market for many moves, and the market will stop them out here. It'll stop them out up here. It'll stop them out on the move back up, right? So the fact that there is a liquidity pool here means that there is a lot of people losing money in this place. So think of liquidity pools and finding liquidity as where banks park to make money, right? So they come in here, they park, and they make money. They come up here and they take this liquidity and they just made money, right? So it's essentially like, so I say that liquidity is money because liquidity is where banks will be making their money essentially. It's places in the market where banks will be making their money. That is what liquidity is. Yes. So we said that after taking this sell side liquidity, most likely we're going to take this buy side. Let's say if we're right. And that we're right, right? We're right. So now it takes the sell side liquidity. Now you guys remember where I told you where the majority of these drawdown entries are going to be for these buys. They haven't let go of these buys. They need them as much as they possibly as long as they could possibly lean onto them. They're going to need them, right? So what do you think is going to happen very soon? What do you think is going to happen very soon? So I see some answers. They say take out buys to go to sales. You need to push up price again, mitigate losses, supply and demand. Breaker block play. The price will come up to the breaker and fall back down because there are still buys there. Exactly. So Tyler nailed it on the head here. There's a breaker block play. Why is this a breaker block play? Simply because banks needed to hold on to these buy positions. But you could say it's an order block that was traded through, right? So you could kind of see like where the order block position would be, and then it got traded through because it wasn't an order block to begin with, but it just looks like one, right? So what happens? This position is the origin of the move that took one and two pieces of liquidity and remitigated this order block, right? It mitigated this order block. So the origin of the move that took liquidity means that there are buys here. Where did they get the option to take those buys out? Well, they could have placed more buys here and closed them here and profit, but would that make sense? No, they're just going to be in deeper drawdown. So what are they most likely going to do? They're going to keep their buys open here, and they don't care about losses all that much. They just care about how much money they're making, right? So what's going to happen? They're going to push price higher, then the price is going to go lower, but they're still holding on to these buys. Price consolidates at once, but they're still holding on to these buys. Now price comes all the way back here, and more than likely, what's going to happen? More than likely, what are we going to see? We're going to see this breaker block, which is from here to here, right? This breaker block take into effect because this is the block where the banks instituted power of three, right? They instituted the amassment of orders. They manipulated price to go higher and take out this liquidity, and then they distributed their profits all the way down, right? So what's going to happen next is most likely we're going to retest this very significant piece of structure, and they're going to go into a bearish position. Why would banks hold on to buys when price comes passing the place where they actually place the buys? Because where else would they place buys? They need buys to stabilize the market, right? So they need those buys to stabilize the market. If they need these buys to stabilize the market, why would we close these buys? Why would we close these buys and place buys up here? Why would we replace them? So like they need these buys. Why would we close them there and put them up here? Wouldn't we be in a lot more loss if we did that? They obviously still need to mitigate them, but they need them also to establish price. So they're going to keep them here because it's at a lower loss, for one. For two, they can also come back and it's less expensive for them to get here rather than coming all the way back up here and putting in more capital to mitigate all the way up there. So what are they going to do? They're going to put it at a lower point where they can come back and, you know, like kind of like backhand mitigate it and then continue on going where they wanted to go in the future. Does that make sense, Alpine? Now, they obviously do need to mitigate these. They need to loosen these buys. They need to mitigate these buys, which is exactly why the breaker block exists. Now, let's actually see what happens. So we enter this price, and how did we enter? Well, really, it could have been like you highlight your area where your breaker block is, right? And then you fib the 50%. It's the same as an order block, just a little bit different. So your entry is right at the 50%. And our entry is right at the 50%, and boom, it got wicked in, right? Or it got wicked in. This is like a chess game. Yes, exactly. I grew up playing chess, and that's one of the why I really like the market, because chess is all about pattern recognition, and it's about responsive adaptation. So what does that mean? Well, if the market moves this way, I'll adapt my game plan by doing this. If I see the market making a move, I will find out the reason why they made that move and toward what end they made that move, right? The long game. Yeah, exactly. It's almost like solving a Rubik's Cube. I've never solved a Rubik's Cube in my life, my friend, ever. But yeah, I guess you could compare it to that. I would also compare it to solving a word puzzle. I would compare it to solving different different mental puzzles, which are also very helpful. It's kind of like do you guys remember those things that you would do with like your grandmother or your grandparents when you went over to their house, like the 2,000, 3,000 piece puzzle pieces? It'd be kind of like that. Yeah, what's up, Chewy? You raise your hand.
You hear me?
Yeah.
Yeah. Question. So at the top where price goes up to that buy side liquidity up there to the left, yeah, that up to right there. Wouldn't that all be considered like more liquidity? Wouldn't it be like a triple top? Now price has to clear that. If you scroll just a little bit more, you see.
No, not quite, because this actually remitigated this. It didn't go past it. So on lower time frames, it didn't go past it. You could technically say that, but you see the difference between looking at like this type of liquidity where it created a clean double top where there was no liquidity in the middle. Here there is liquidity in the middle. So it actually broke this liquidity. It took liquidity here. Look at the difference between these two scenarios. It took liquidity down here. It came back and remitigated this order block first of all, and then it also took liquidity one and it took this liquidity two, which is why this is justified. So they already loaded up this move to take liquidity. Now with this liquidity, they already expressed this liquidity by making this move downward. So they don't really need to take any more liquidity at that point where they're just, relying on the liquidity that they took here to make and establish this move to move it all the way back up. to this position. Does that make sense?
Yeah, that makes a lot of sense.
Okay.
Appreciate it.
No problem, man. Awesome. So we got wicked into our entry off the 50% entry off of the breaker block. And now here's my question to you guys also. Where would you put your take profit? And why? So as we see here, more than likely we put our take profit at a pretty decent area. What do you guys think I put my take profit at at that area specifically? Right. So there was this significant piece of structure. So what I would really do when it comes to setting my take profit is, firstly, there's the first kind of order of business is securing your profit. Now, where would this profit be before the order block? You could say this is an order block. You could say this is an order block technically as well on maybe the daily. You can say, however, I placed my take profit there because of the fact that price, so like the bullish move to take price higher and actually like take out this liquidity was based out of this position here, which already tapped into this liquidity pool. So I would kind of discard that, and I wouldn't really say, like, if price does go all the way down there, okay, cool. But I would only seek to take profit around the area of this previous liquidity, right? So previous liquidity is something that you guys can also use. However, I was looking at previous structure, and where was structure that actually defined the bullish move? It was right here. So what I use is I use previous structure, and I use saying, okay, so you have this piece of liquidity here, right? No, sorry. Yeah, you have the beginning of this liquidity pool here, and you also have the beginning of the move upward, which was defined by this retrace and reaccumulation, right? So where would you place your take profit on your breaker? Your breaker block, firstly, would be taken here. What would be the place where buy side liquidity would be taken? So the sell side liquidity would be taken. You just took buy side, so now we need to take sell side. Now, where's the first sell side point? The first sell side point would be right around here. So the first point of sell side liquidity would be right around that area, which happens to be our take profit. So that would be your first. This would be your second, and down here would be your third. Now, usually I don't like having multiple take profits because a lot of people, like a lot of companies, what they'll do to boost their stats is they'll like, oh, take profit 1 or take profit 2 got hit, and the trade only went 10 pips into profit, and then they say, oh yeah, TP1 hit, right? And then what people don't know is that they don't see TP2, TP3 because price went 10 pips in their direction and then it reversed 200 pips, right? But at the same time, we have to realize that there are different targets in the market. So with those targets in the market, we could have closed 30% of our, or 33% of our orders when our first TP got hit, right? And then we could have closed more orders. We could have put our stop loss halfway in, and then the rest of our orders would have gotten stopped out halfway. Would the left liquidity pool still matter after it being mitigated? Which liquidity pool? This one and this one, or this one? So A, B, or C? This one? After the dip. Oh boy. I think I'm a little bit confused on where you say, bro. This one. So this liquidity pool would not really be of much use to us because it was already dipped into. So whatever the banks wanted to mitigate at that point, whatever the algorithm wanted to mitigate at that point, it already did. So that's exactly why I kind of discarded this as a liquidity target. The max I would have taken my liquidity target toward would be this bottom red line, because that was the liquidity pool that kind of originated the move upward. But I also wouldn't want price to plummet all the way down here because that would just make really awkward price actions. So yeah. Um, yeah, guys. So remember that you guys can use, why do you think the market is shooting up so high? The market shooting up so high, like right here? Like, why is it shooting up so high? Well, there can be many things. There can be many orders. Like there could be many factors that influence the market taking such a bullish perspective. Firstly, when I see you looking at this type of analysis, um, could you have used the IG sentiment as a confluence for that trade? I would not use the IG client sentiment. Exactly, perfect, Candice. Weak dollar. So I would not use the IG client sentiment. I would use the DXY. So use the dollar index. So say you use the DXY up on your trading view, right? And you see that there's going to be a weak dollar. And let's just pretend, right? We're looking at the same chart. Let's just pretend we're looking at the same chart. And we see that there is a really weak dollar, or that, we see a bearish order block, and the DXY tapped that bearish order block and now is falling. What is the pair that is immediately correlated to the DXY? Euro USD and GBP USD, right? So what's going to happen? More than likely, if that dollar is really weak, that dollar is going to end up shooting GBP up higher, right? GBP USD up higher, or the majors up higher. Now we also see that price in this case didn't quite make bullish, didn't quite make bearish potential, right? So in this case, we mitigated this inefficiency, and then we went up higher to take buy side liquidity. Now we came lower and we actually failed to break this low. So we failed to break this low, and then it came up and started making bullish movement. Now remember, we are on the 12-hour, so it isn't as refined as we would like it to be. However, if we would go on the 12-hour, more than likely we would be a position in which bullish establishing, like when this bullish move would have been established. Wait, how do you know, how do you correlate the dollar chart to GBP? Okay, let me actually give you guys some notes. So I'm going to give you guys some notes really quickly. This is something known as, smart money divergence. If my Zoom doesn't crash. Okay. So smart money divergence. Okay, smart money divergence is something that's going to be quite important, right? Now, this is going to be the correlation towards the dollar and different major pairs. So let's say that the DXY is going up. That means it's strong dollar. This will result in a bearish GBP. Okay. Okay, now if the DXY is bearish, that means that you will have bullish, so weak dollar. You will have bullish GBP USD, EU, whoops, and just generally XXX USD will be bullish if the DXY is going lower, right? So we have that. Now we also have Euro GBP and the actual GBPs, right? So Euro GBP, if it is going up, then GBP will go down. Now if Euro GBP, oh, so GBP USD, so like, okay, so with Euro GBP, there's a bit of a weird dynamic, and let's do this in this way, right? So let's say that Euro GBP moves up, and that day GBP USD moves down. Euro USD will consolidate. Okay, Euro USD will consolidate. Does everybody have the DXY notes written? I'm going to delete them. Everybody have the DXY notes written? Yes? Okay, awesome. I'm going to delete them. There's actually a shout out to one of my really good friends from Vault. He actually taught me this. So Euro GBP, if it goes up and GBP USD moves that day, Euro USD will consolidate. However, if Euro GBP will, like, let's say that night it goes up, right? And then GBP USD consolidates, or GBP XXX, right? Whatever the case may be, consolidates, then Euro XXX will fall, right? So it's the same thing here. If one or the other will usually take the move, and that's something that you guys will learn with experience. Usually either the Euro pairs will take the move that night or the GBP pairs will move that night. Either way, do your technical analysis, just use this as an additional confluence. Now let's say Euro GBP goes down, and let's say GBP USD, or GBP, whoops, I can't spell apparently, GBP XXX will go up, then what's going to happen with Euro XXX? What do you think is going to happen? What is it going to do? Most likely consolidate. Perfect. It's most likely going to consolidate. Very, very good. Now, on that same note, we can flip this, right, and say if Euro GBP, like if Euro XXX starts going up, GBP XXX will consolidate. It's the same thing. That is smart money divergence. Those are really the only pairs that I want you guys to learn, because if the dollar is down, here's a very simplistic note. Let's do it this way too. Oh, sorry. Does everybody have the Euro GBP, and Euro consolidation thing situated? All the notes situated? Speak now or forever hold your peace. Okay, awesome. So let's say, right, if the dollar, let me just write this down one more time. DXY goes up, that means strong dollar. Everything matched against the USD, so XXX USD will go down. Meanwhile, USD XXX will go up. Okay. Same thing if it goes weak, right? If the DXY is down, is down, that means weak dollar. What does this also mean? That means that XXX USD will go up, right? And USD XXX will go down. Does that make sense? Perfect. Awesome, guys. Awesome, awesome, awesome. So has everybody learned something from this class? I hope everybody has learned something from this class, guys. All right, guys. My time is about up. Does anybody have any questions that you guys want to ask before I go? Best way to learn more about inefficiencies. We're gonna actually record a video on inefficiencies. Recently, we've been reevaluating some of our definitions so that we can teach them to you guys a little bit better. In the new year, we're going to be coming out with a 100, 200, and 300 level course. Think of it like college. You know how you had like your undergraduate classes, like your general educational classes, and your major specific classes, and your mastery classes, and your master classes, and your PhD classes. We're going to have them like that, structured like that on the website. It's still going to be free until further notice. So don't worry about paying anything. It's going to be free. But if you want to learn more about finding liquidity pools, yesterday we did a class, Zay did a class on liquidity. It's in the recorded videos section of the Discord, and it's also on the website. I would rather you watch it on the website because we may be stopping uploading videos on the Discord, and they're just going to be exclusively on the website for all of you guys to do it. I registered on the website. Am I supposed to receive an email? Yes, you are supposed to receive an email. I believe Zay is the only one with the power to accept people. We're going to try to work on that because currently it's a little bit kind of inconvenient how we're doing it, but I think we should be able to fix it here in a little bit. In terms of the website link is empiretrategroup.com. empiretrategroup.com. And all that you need to do is you need to make an account, just your email and your name, and that's it. And then from there, you will get access to all of our videos that you guys may want. So that's the website. It's empiretrategroup.com. You guys can just go visit us over there, and that will help us out massively. This is going to be on YouTube, so you guys can also rewatch this on YouTube. John, if you want to learn more about, actually, let me get the link for you because it's actually on the Discord. I just want to make it a little bit more easier for you, anything to help you out. So let me get you the recorded class, and it's the beginner session with Zay. This one should help you a bit. I was on it last night, and he does speak on liquidity pools. So unless you were on there already, in which I can send you another video. But yeah, in that case, I think that's going to be about it. Thank you guys so much for being here. And this video will go up on the YouTube as soon as it's done rendering. Thank you guys. Take care.